America looks rich. The stock market is high. Consumption is everywhere. Confidence fills the headlines. But here's the strange part. The richer America looks, the more fragile it feels. People work longer hours, spend more, carry more debt. Yet security feels thinner than ever. This isn't a contradiction, it's a clue. Because America didn't become poor, it became unbalanced. For decades, America has projected strength, economic dominance, military power, the world's reserve currency. And on the surface, that strength still exists. The dollar is powerful. Markets are deep, capital flows in. But underneath, the structure supporting that image has changed. Growth is no longer built on balance, it's built on leverage. Government debt keeps rising, corporate debt keeps expanding. Household debt becomes normal. Wealth concentrates upward. Risk spreads downward, and the illusion holds as long as confidence holds. This is why America can feel rich even while being financially stretched. Because perception has replaced resilience. The system rewards motion, not stability. Spending, borrowing, consuming. As long as money moves, the image remains intact. This is where politics enters the story. Movements like America First didn't appear out of nowhere. They reflected a feeling that something wasn't adding up, that the country looked strong, but felt vulnerable. By the end of this video, you'll understand why America's wealth is more visible than durable, why debt replaced balance, and why both Americans and Europeans are sensing the same tension beneath different systems. This isn't a story about collapse. It's a story about imbalance. And to understand how America reached this point, we need to look at what its economy was actually built to do. To understand why America feels rich, we need to understand what its economy was designed to do. The American system was never built to preserve balance. It was built to expand. Growth became the objective. Speed became the advantage. Scale became the solution. After World War II, America emerged as the center of global production and consumption. The dollar anchored trade. American demand anchored growth. This created a powerful loop. Americans consumed. The world produced. Dollars flowed outward and came back as investment. At first, this system was productive. Wages grew. Industry expanded. Living standards improved. But over time, growth began to rely less on production and more on credit. When wages slowed, borrowing filled the gap. When productivity stalled, leverage replaced efficiency. Debt became the lubricant that kept the machine running. Households borrowed to maintain lifestyles. Corporations borrowed to boost returns. Governments borrowed to stabilize cycles. Each layer depended on the next. Consumption justified debt. Debt justified growth. Growth justified confidence. This is why America's economy looks powerful from the outside. Motion is constant. Spending is visible. Markets are active. But motion is not the same as strength. A machine can run fast even while wearing itself down. The American growth machine rewards expansion over restraint. Borrowing over saving. Consumption over resilience. This doesn't mean the system is broken. It means it's doing exactly what it was designed to do. The problem is not growth itself. It's what growth is now built on. Because when expansion depends on debt, stability becomes fragile. In the next part, we'll look at how this system reshaped wealth inside America and why the benefits and risks no longer fall in the same places. Every economic system distributes rewards and risk. The question is not whether America's system works, it's who it works for. For a long time, growth lifted most people together. When productivity increased, wages followed. That connection has weakened. Today, gains concentrate in places most people don't directly touch. Asset markets, capital ownership, financial leverage. Stocks rise, property appreciates, balance sheets expand. Meanwhile, wages move slowly. Job security becomes conditional. Benefits become negotiable. This creates a quiet divide between those who own assets and those who depend on income. Asset owners benefit from expansion. Rising prices increase their net worth even when productivity stalls. Income earners absorb volatility. Inflation reduces purchasing power. Debt increases vulnerability. This is not a conspiracy, it's a structural outcome. When growth relies on credit, returns flow toward those closest to capital. The system rewards positioning, not necessarily contribution. Being early matters. Being leveraged matters. Being inside the financial flow matters. This explains a common feeling that no matter how hard people work, progress feels temporary. Gains can be reversed. Costs feel permanent. In this environment, wealth becomes less about building and more about defending. The middle compresses. Those at the top grow insulated. Those at the bottom become exposed. This is why frustration rises even when markets look strong, because prosperity is visible but not widely felt. Political movements on both sides of the Atlantic draw energy from this gap. The anger is not abstract, it's rooted in lived experience. In the next part, we'll look at how politics, including figures like Trump, interact with this imbalance without actually resolving it. When systems drift out of balance, politics doesn't fix them, it reacts to them. This is where figures like Trump enter the story. Trump didn't appear because the system failed. He appeared because the system stopped feeling fair. For millions of people, the promise was clear. Work hard, follow the rules, and life improves. When that promise weakened, frustration searched for a voice. Trump spoke directly to that gap, not with policy depth, but with emotional clarity. America First wasn't a plan. It was a diagnosis. It captured a feeling that America looked powerful, but ordinary people felt exposed. Trump promised control. Control over trade. Control over borders. Control over outcomes. But here's the uncomfortable reality. Political leaders don't control systems built on leverage. They manage narratives. They shift incentives. But they don't rewrite foundations. Trump didn't reverse debt growth. He didn't restructure consumption. He didn't rebalance capital flows. And neither did his successors. Because the system demands expansion regardless of leadership. Politics can slow trends. It can accelerate them. But it cannot easily stop them. This is why each election feels more intense than the last. Expectations rise. Results disappoint. Control is promised. Complexity is delivered. Trump didn't create America's imbalance. He made it visible. And visibility changes politics everywhere. In Europe, similar movements followed the same pattern. Different languages, same pressure. The question isn't whether leaders can fix the system. It's whether the system allows itself to be fixed. In the next part, we'll look at why America's strength now creates pressure on Europe and how this imbalance is becoming global. America's strength does not stay inside America. When the U.S. economy expands, its effects ripple outward. And nowhere are those ripples felt more clearly than in Europe. The dollar sits at the center of the global financial system. Trade is priced in it, debt is issued in it, capital moves through it. When America tightens, the world feels pressure. When America loosens, the world adjusts. For Europe, this creates a structural challenge. European economies value stability, regulation, long-term balance. But global capital does not value patience, it values returns. When U.S. interest rates rise, capital flows toward America. Safer assets, higher yields, deeper markets. Europe responds defensively. Rates adjust, growth slows, policy tightens. The result is tension. Europe must protect stability while competing for capital. This pressure shows up in subtle ways. Energy costs, industrial competitiveness, investment outflows. American companies attract funding. European firms face higher barriers. This doesn't mean Europe is weak. It means Europe is constrained. Stability requires restraint. Restraint limits speed. America moves fast. Europe moves carefully. In a system that rewards motion, speed often wins attention. This creates a growing imbalance. American markets look dominant. European economies feel pressured. Yet both regions face the same underlying issue. Growth built on leverage increases fragility everywhere. America exports volatility. Europe absorbs it, and neither side fully controls the outcome. In the final part, we'll step back and ask the hardest question. What happens when the image of strength becomes more important than real balance? Strength feels reassuring. It signals control, confidence, momentum. But strength without balance carries a hidden cost. When an economy relies more on perception than resilience, fragility builds quietly. America still looks powerful. The dollar dominates. Markets attract capital. Consumption remains strong, but the foundations supporting that image are increasingly stressed. Debt replaces savings. Speed replaces stability. Expansion replaces repair. This doesn't trigger collapse. It creates dependence. Dependence on growth. Dependence on confidence. Dependence on constant motion. The moment motion slows, the system feels exposed. This is why stability feels temporary. Why every slowdown sparks outsized fear. The issue is not that America is weak. It's that its strength no longer rests on balance. Europe senses this. So does the rest of the world. Different systems, same tension. Everyone is adjusting to a world where growth is fragile, confidence must be maintained, and shocks travel faster than solutions. This doesn't mean collapse is inevitable, but it does mean the margin for error is thin. Understanding this matters, because it explains why people feel uneasy even when numbers look strong. It explains why politics feels louder, why markets feel nervous, why the future feels conditional. America feels rich, but feeling rich is not the same as being secure, and that difference is shaping the next chapter of the global economy. Welcome to Financial Room,